So one question on everyone's mind is the housing market going to crash in 2024? We've all seen the headlines the past 3 years about the rising cost of housing, and recent data from Redfin has shown that this isn't getting any better. But is there actually going to be a housing market crash in 2024? Let's dive into the data. So recently, data has shown that home prices were up roughly 6%, which is double the average appreciation for homes over a 12-month time span. So currently, the average price of a home in America is around $432,000, and this certainly hasn't slowed buyers down from going and purchasing that new house. Roughly last year, 450,000 homes were sold, and that figures up roughly 8% over the previous year. And honestly, these numbers kind of surprise me. I mean, the Federal Reserve is making it harder for home buyers to purchase homes with higher interest rates, but people are not slowing down. They're finding ways to buy these new houses. But when talking about economics 101, currently, when it comes to supply and demand, there are more houses available for purchasing than previous years. This number is actually up 13%. So the supply of houses is up roughly 13% versus the year prior. So that's looking pretty promising. So certainly, if you're trying to get into a house and maybe a first-time home buyer, this is positive news, seeing that the supply of homes is increasing and has increased 13% over previous years. But the demand still seems to be there. People are still out there buying these houses. So one more data point that's pretty interesting is that the current average mortgage interest rate is around 7.1%. And this is up dramatically from 5.2% a year ago. And what this tells me is that people are finally giving up their pandemic age 2.5% mortgage rate and sucking it up and buying that house they've been eyeballing for a few years now, despite the 7-8% mortgage rates we currently have. So to sum it up, it costs roughly 75% more to have a mortgage now, today, versus when the pandemic started. But this is not slowing buyers down. They're still going out, they're still getting new mortgages at these higher rates. So currently the average mortgage payment is around $2,800 a month. This is up a whopping 13% from 2023. But the real question is, why haven't we seen the massive drop in housing prices reflected with these higher interest rates? But my thoughts on this is people are planning to refinance in 2 years at a lower interest rate and get that lower mortgage payment. But that's a really big if. And if you think about it, this could be the reason the housing market eventually does crash. You know, if people can't really afford their mortgages past a couple years out and then they can't refinance, maybe rates are higher in the future, they're stuck with that. And maybe we'll see some foreclosures then. And that alone could be the reason the housing market really takes a hit. And in all actuality, Americans should not be basing whether they can afford a house on the fact that they may or may not get to refinance 2 years down the road. I mean, if you think about it, that's one reason 2008 recession even happened. But honestly, unless we see mass layoffs in the last 2 quarters of 2024, I believe borrowers will be able to afford their mortgages for the rest of the year. And the reason for that is the bank probably wouldn't have lent them that money if they couldn't afford it for the near future. But basically, I just don't see a housing market crash in the near future. I mean, supply is certainly increasing. We saw the $450,000 homes being listed this year, which is up, 8% from the previous year. So you have more supply there. But unfortunately for home buyers, the demand is still there. People are still buying these houses. And until you get rid of that demand, you will not have a housing market crash. Housing will actually increase in value as long as the demand is there. It's, like I said, basic economics. Now, if we see unemployment spike from currently 4% to say 5%, you're definitely going to see some foreclosures. And honestly, I don't know how Americans are able to afford these $2,800 a month mortgage payments. They just can't have their disposable income there. So if they have any other spike in their expenses, medical bills, house insurance spike, or maintenance costs in general, you will see some foreclosures there, which could help decrease the housing market prices. But recent data has shown that foreclosures have increased 2.8% this year alone, which may be a negative sign for the housing market. Maybe if we start seeing some foreclosures, there'll be more supply of houses out there, which will lower the prices of houses in general, and maybe even cause a housing crash at one point in time. But in summary, obviously housing is outrageous, rent is outrageous. Like I said in previous videos, the more expensive housing gets, the more expensive the home insurance is, more expensive taxes are. So it's a snowball effect. And it's one of those things that you may be able to afford a mortgage payment now, today, but what about the next 2 years? Don't sign up for a 30-year mortgage thinking you're going to be able to refinance for a cheaper rate a couple of years from now, because that may or may not happen. Mortgage rates are higher now than they were 3 years ago, definitely, but there's no guarantee that they're ever coming down. In fact, they may even get higher. So definitely plan for the future, have some flexibility in your budget, have some wiggle room, and have that emergency fund. I appreciate you watching the video. Please like and subscribe, and I'll see you next time.